Ladies and gentlemen, this time is very, very different, and you need to prepare right now. The world is changing. We're going from a prolonged period of peace to a prolonged period of conflict. It started out with the war between Russia and Ukraine. Now the war between Israel and Hamas, with the potential of Iran joining that conflict. And if they do, the US will be following shortly after. And at this time when US resources are spread between Ukraine and Israel, China may see this as a perfect time to strike for Taiwan. So in today's video, I'm going to go over all the latest news, what's happening in the markets, but I'm also going to give you the research, the facts and data. What happened to inflation? What happened to interest rates during World War I and World War II? Because the best way for us to predict the future is to look at the past. And the best way for us to learn from history, what many people don't do, is to look what happened in history, figure out what happened in similar times, and then we can prepare for what is coming. So everyone, this is going to be one of my most important videos I've done. We all need to wake up. Things are changing very, very rapidly. You need to prepare your finances, get your house in order for what is coming. So everyone, let's get into it. Well, first things first, this is huge, everyone. We're going to see inflation skyrocket out of control, and we're going to see more supply shortages and more shutdowns of key commodities. Look at this. Israel orders shutdown of key gas field as war rages. The government temporarily closes Tamar field on security concern, and Chevron has been looking to expand output in the region. Now again, why we have to look at this, because what happens to inflation will affect interest rates. What happens to interest rates will affect the economy. What happens to the economy will affect your job and your finances as well. Listen to this. Due to the situation, the security establishment ordered to temporarily stop the supply of natural gas from the Tamar reservoir, the nation's energy ministry said in a statement. Now, gas discoveries in Israel over the last 2 decades have transformed the nation's economy, and the shutdown of the field about 50 miles, 80 kilometers west of Haifa, threatens its plans to become a major regional supplier. Israel in August said it would export more gas to Egypt from the project amid strengthening ties with its neighbor. And this could be one of the many reasons why Hamas chose to strike now. Israel has been brokering deals in the Middle East, with this deal with Egypt to supply Egypt with gas, but more importantly to Iran, that's got Iran so worried, was brokering peace deals and more economic deals with Saudi Arabia. Now, Saudi Arabia and Iran hate each other. Saudi Arabia, if they team up with Israel, would be a huge threat to Iran, and that may be why they allegedly, we don't have 100% proof that they backed Hamas. That may be allegedly why they chose to strike now. Now, some of the supply to Egypt goes on to Europe as well, so it will affect Europe, where buyers are increasingly relying on alternatives to the Russian pipeline flows. In the short term, the field stoppage may result in lower onward shipments or even delays. Gas prices in Europe surge as much as 14%. So everyone, this is going to have massive, massive consequences for inflation and for interest rates and for the markets. So I'll bring up this graph here. We can see Egypt is aiming to boost LNG exports from 2025. Now, Chevron has been looking at how to expand output in Israel and supply the fuel to neighboring markets or convert it into LNG for Europe, including the possibility of floating a plant. Now, Chevron has been looking at how to expand output in Israel and supply the fuel to neighboring markets or convert it into LNG for Europe, including the possibility of a floating plant. So this would have been absolutely huge for Europe. It would have greatly reduced their gas prices, but now the opposite is going to be happening, and it will affect their economy. Now, Saturday's surprise attack by Hamas and Israeli subsequent response raised questions about the future security of the region. The combined death toll in the conflict is already at more than 1,100 as the fighting continues. So this is a huge, important supply of gas for the region and even for Europe as well. But what could be even more devastating for the global economy, for the markets, will be if this conflict spreads throughout the Middle East, which it does definitely have chances of doing, with Hezbollah attacking from South Lebanon, with also a lot of countries in the Middle East standing in support for Palestine. If this happens, we're going to see oil surge to an absolute unthinkable price. Because look at this, everyone. Zero Hedge put out a report that oil could spike well north of $150 per barrel. And guess what? If that happens, your fuel will get much more expensive, your groceries will get much more expensive, everything shipped to you will get much more expensive, and we will experience unbearable inflation. So okay, we know there's so much uncertainty in the world right now. We know there's a very, very high risk of inflation, of big shocks happening to the global economy and the markets. But again, can we look back and learn from history what happened so we can prepare today? Well, everyone, I've been doing extensive research. What happened to inflation? What happened to interest rates during World War I and World War II? And this is what I found. So guess what? Actually, at the start of World War I, inflation was just 1%. That's because everybody was freaking out, people weren't spending, and it was not much inflation. But then things all began to change. The inflation rate during World War I increased significantly, specifically during 1917 and 1918, when the inflation rate went from 1% in 1914 to 17.4% in 1917 and 18% in 1918. This was because of many factors: the cost of the war, supply disruptions, and increased demand for goods and services. Now, what happened to interest rates during World War I when inflation spiked? Well, you would think that they'd lift interest rates or they'd tighten monetary policy. No, the opposite happened, everyone, because the Federal Reserve was established shortly before the outbreak of World War I, and its policies during the war were aimed at supporting the US government financial needs. Back then, there was no specific data on the federal funds rate as it's known today. The Federal Reserve did set low discount rates on loans secured by the Treasury securities to encourage banks to purchase US government securities. This helped finance the war effort and also affected interest rates during this period. And the Fed's open market purchases increased system holdings of treasuries from 66 million in 1917 to, listen to this. This is huge. This is almost tripling the amount of treasuries they had to 236 million in 1919. Now again, this may seem like small figures because, the US had much more purchasing power back then. That's pretty much like the Federal Reserve going from a balance sheet, what they have now, of around 8.8 trillion all the way to 24 trillion in a matter of a few years. So during World War I, we saw inflation skyrocket, and instead of Federal Reserve selling assets and lifting interest rates because safety and preserving the US government and the US empire was the number one priority, inflation was thrown to the curb. But okay, we can't just look at one time. We need to look at another period. What happened to inflation and interest rates during World War II? Well, in 1941, inflation was pretty high, around 5%, but then it spiked to 10.9% in 1942. Again, this was due to huge costs to fund the war, and also post-World War II in 1947, inflation surged to 20%. And do you know how they try to control inflation during World War II? Well, that was price controls and rationing. But of course, after those price controls were lifted in 1947, we saw inflation spike out of control. Also, there was wage price controls. The Office of Price Administration, OPA, was established to control prices and rents, and War Labor Board helped manage wage disputes to prevent runaway inflation. But I think we all know what comes next, and this is going to be very, very burdensome for the average US citizen. To fund these wars, it was higher taxes. The government also increased taxes and sold war bonds to the public to absorb excess money in circulation, which helped in controlling inflation to some extent. So again, just like World War I, in World War II we saw record inflation, but what happened to interest rates? Well, could have you guessed it, they were dropped again. In 1942, the Federal Reserve committed to maintaining a low interest rate peg on government bonds at the request of the Treasury to allow for cheaper debt financing of the war. This peg was maintained at 3/8% or 0.375% per year for Treasury bills, which was significantly lower than the typical peacetime rate of 2 to 4%. So that's right, everyone. During World War II, we saw price controls, rationing, and interest rates on short-term treasuries, that's IOUs, were pegged at 0.3%, even though inflation was about to skyrocket. And also what the Federal Reserve did was they monetized the debt. So the Federal Reserve pegged interest rate at a low level during World War II to facilitate the financing of government debt. This peg was enforced for 6 years after the war ended, illustrating the extended impact of wartime monetary policy on the Federal Reserve's funds rate and other interest rates. So this did help the US government fund their wars, although they represented a departure from normal monetary policy and operations, with the Federal Reserve taking a more active role in managing interest rates and supporting the government debt. So what this simply means is, everyone, if this conflict escalates to a more broader conflict, if China goes after Taiwan, or if Iran gets involved in this conflict and this breaks out to a much bigger conflict with the US getting directly involved, well, guess what? We're going to experience huge inflation, and the Federal Reserve isn't going to do anything to stop it. The war will be their number one priority, and they will finance it at whatever cost. But you know what they say, during every crisis, there is always huge opportunity. And a huge opportunity I'm seeing right now is in the uranium market. So as we can see here, everyone, uranium is absolutely skyrocketing, going from around $23 in 2020 to now surging over $72. And look at this 1 year chart. We can see this chart here is going absolute parabolic. Now, when you look at previous bull runs with oil, we also see uranium go up, and it normally does massively outperform. So the global landscape is rapidly shifting, with an ever increasing focus on clean, reliable, and efficient power sources. At the heart of this transition is uranium, a critical component for the nuclear energy, which stands at the forefront of meeting the escalating demand for carbon-free, zero-emission energy solutions. Amid the backdrop, the uranium market experiencing a monumental bull run, making a historic lucrative entry point for investors in the uranium-centric ventures. Now, let's venture into the Athabasca Basin in Canada, the world's premier uranium region, known for its high-grade uranium resources. And here lies the big opportunity I want to tell you about. Today's video sponsor, Atha Energy, that's stock ticker SASKF, a company heralded as a mega explorer with the largest land package in the uranium-rich basin. This monumental land ownership is a result of over 2 decades of strategic acquisition by seasoned prospectors Matthew Mason and Timothy Young. The duo's expertise has already fostered the genesis of notable players like NextGen and ISO Energy that is up over 780% over the past 5 years in the uranium sphere. Now, Atha Energy sits on an enviable cash position, with $25 million in hand, furnishing the financial muscle to spearhead extensive exploration endeavors for years to come. They are not just a land behemoth, their assets also include a 10% carried interest in the lucrative projects of NextGen and ISO Energy. This diversified portfolio renders Atha Energy almost akin to an exploration ETF, but with a similar focus on the uranium bounty awaiting in the Athabasca Basin. Now, the market dynamics are overwhelmingly in favor of uranium. The recent reopening and ramping up of uranium mines, although a 2 to 4 year journey to full production, underline the industry's resurrection to meet the skyrocketing demand. Furthermore, historical data showcases a positive correlation between uranium and oil in past bull markets, with uranium often outperforming. Now, we also need to talk about the political winds blowing in favor of uranium with bipartisan support. The Department of Energy, DOE, has inaugurated a $6 billion program, and legislation curbing uranium imports from adversary nations is navigating through US Congress. Even tech moguls like Elon Musk and corporate giants like Microsoft are championing the nuclear cause, underscoring its pivotal role in ensuring both national and international energy security. Atha Energy is not merely an early entrant in this market, it's a titan with unprecedented access to the world's richest grade uranium region. While they've not drilled yet, their foundation work has already unearthed hundreds of pounds of uranium, setting a robust precedent for what lies beneath their vast holdings. The narrative around Atha Energy is not just about the present, but about its immense potential that's primed for a swift ascent. With the world rallying behind nuclear power and Atha Energy's unmatched land position, financial stability, and strategic alliances, is poised to rise the uranium wave to a zenith that few can rival. Atha Energy's narrative is emblematic of a rare confluence of market opportunity, robust financial health, and unyielding quest for uranium exploration. For those new to the uranium narrative, this is a call to partake in a venture that's been 12 years in the making and now stands on the cusp of a geophysical survey aimed at unveiling the next big uranium discovery. The soaring grades of uranium in the Athabasca Basin, tenfold higher than the global averages, further amplify Atha's energy position as a venture that's in a league of its own. So in conclusion, Atha Energy, that stock ticker SASKF, represents a unique, robust, and timely opportunity into the world's most promising uranium region. Its vast land holdings, significant cash reserves, proven prospecting acumen, and strategic stake in other successful uranium ventures craft a narrative of unparalleled potential in the uranium bull market. But everyone, just a quick disclaimer, past performance is no guarantee to future performance. Do your own due diligence to figure out if this is the right opportunity for you. So okay, everyone, I know you think, what does all this mean for you in simple terms? What this means is, everyone, with the conflict breaking out throughout the world, I think inflation is going to surge higher. Unfortunately, I think interest rates aren't going to do anything to stop it, because safety will be their number one priority. Defending the US, defending US interests will be their number one priority. They're not going to do anything to stop it, and we could see a massive market melt up. We could see the dollar's purchasing power fall as they print more money, as they finance these conflicts, and you're definitely going to want to have commodities in order to protect against your purchasing power diminishing. But everyone, what do you think about all this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.